Hello, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin. It is August 14th, Sunday, about 1:20, and we're looking at a chart of the S&P 500, and the market was pretty much flat for the week. In fact, most of the major indices were flat or just slightly up or down for the week. Not a whole lot happened one way or the other. Last week we talked about the start of some pullback happening, and we've yet to see that. In general, just everything seems to be taking longer in this particular part of the like all last year. You just had this slowly rolling over. It just took forever. And now you got kind of this test, which could be the final test, coming up and just taking forever. It's just, look at the last 1, 2, 3, 4, 5 weeks of really nothing really substantially has happened. So it's a very frustrating market environment to be in. Of course, if you're not expecting a pullback, or worse, then it's probably a very comfortable place to be in. And in fact, that's where complacency a lot of times comes from, is from the market kind of lulling you to sleep, and then bam, it knocks your socks off. So we'll see. There's no way to know really what's going to happen, but clearly, you can see here that, and this is pretty indicative of just the broad indices in general last week. That's the open. It opened and closed right about the same place. Open, ran down, came back up, closed down a little bit, and opened and closed about the same place. So that's fairly uneventful as an investor or trader. So let's look at. We can look at the other indices real quick. This is the Dow. If I can get it to come up. There we go. This is the Dow. So you can see the Dow was slightly up, made a new high, but then pulled back. You can see the Dow Jones Composite was pretty much down, but uneventful. You can see the transports. The transports were actually down, so less uneventful, I guess. Utilities were flat to down. So if I can get it to come up, there we go. Utilities, you can see here, slightly, just basically flat. Nothing going on there. Nasdaq down, or no, slightly up rather. Nasdaq 100. So the Nasdaq 100 is the largest ones, and you kind of would expect that because whatever money is flowing out there is flowing into the names like Facebook and Google and Amazon, and which are the leaders in the 100, Nasdaq 100, and then back to the S&P 500, flat. So that's what's going on in the broad market today. Let's look at our 13-week Treasury. You can see we've broken below the line. In fact, let's just adjust it just a hair to right there. And I'm kind of halfway expecting this to rally up here a little bit and potentially close above this high over the next week or two, just because you're starting to get some additional financial stress in the market. I don't know how many of you have been, it really hasn't hit the major news yet, but you got some serious problems with the Italian banks. Just to kind of put it in perspective real quick, when we had our mortgage crisis back in 2008, the default rate on quote unquote, bad mortgages or subprime mortgage. It really wasn't subprime. It was really just all mortgages, but the subprime was kind of exacerbating things, I guess. But in general, the default rate on mortgages was about 5%. Well, what they've got going on in Italy right now is 17% default rates on mortgages. And Germany and the rest of the European Union and the ECB, they're trying desperately to figure out how can we keep this contained. And they're talking about a bail-in. So a bail-in is different from a bailout in the sense that the depositors that have money there would make up the difference, not the taxpayers. So they would actually just come into your account and take, let's say that, if they took 20% of everybody's money, that would make the bank solvent. Well, they just come in one day. You come in one day and you have 20% fewer dollars or euros in your account than you had the day before. That's how a bail-in works. So they're talking about that. They're talking about a couple other things. The bail-in is, not very politically cool. So the Italian leader over there is really pushing Germany and the ECB to do more of a bailout, where you spread the losses over all Europeans. And this could, the whole Brexit thing could be just the first shoe to drop in a just complete unwinding of the euro. Because when you start getting with people's money and this kind of thing, this really separates people pretty quickly. All this kumbaya feeling they get by being in the same European Union, all that goes away when people start feeling like, golly, you're taking my hard-earned money to bail out somebody who did this or that wrong, and this kind of thing. So the other thing you have going on is you've got Deutsche Bank is under a lot of stress too. So you got the Italian banks in general, and then you got this large mega bank in Germany called Deutsche Bank, and LIBOR rates are starting to spike up a little bit. I don't have a chart for LIBOR, but LIBOR is the London Interbank Offer Rate, and it's an overnight rate that banks charge themselves to just balance their books overnight. And so just because of normal fluctuations of doing business in banking, you get imbalances, and so they borrow money from each other to shore up those imbalances, and where net assets minus liabilities equals zero or whatever. So that's kind of what the LIBOR is used for. And all these interest rates are connected in some way or another. And so, we've been looking at this 13-week interest rate. And because of what's going on in LIBOR and because of what's going on in these banks, you could see this 13-week number start to drift up here over the next several weeks. And like I said, if it does close above this area right here, above this point, this 0.35% area, we could see the Fed raise rates almost exactly at the wrong time. I mean, it's going to be incredible probably, but anyway, it is what it is. So the 10-year is still way down here in the lower part of this range. Let me put it in the center of the screen so we can all see it. Way down here at 1.515, and what I see here is it's either going to pull back to just below here and bounce pretty authoritatively, or we're going to make a new low. No way to know just yet which one it could be. It could easily be just the first pullback after the first move up. So let me kind of clarify what I'm saying here. This would be your first move up. This would be your first pullback. And then we've talked about this before, but usually this move here is pretty substantial. could be, something like, well, it could at least be something like that. In which case, that's what we'd be looking for, right? A break of this downtrend line, and then probably some sort of pullback into this area, and then another high. So that's one scenario. The other scenario is we just come and make a new low below this low. So we'll keep an eye on that. We'll see what happens. See how that plays out. The volatility index, well, the volatility has been very, very low. This is one of the reasons we're expecting some sort of pullback here. In fact, let's pull this out. I mean, the volatility really hasn't been this low since mid 2014. And periods of high volatility, I know this sounds kind of silly, but periods of high volatility follow periods of low volatility. So we've had this one gigantic period of low volatility, which portends the probability of high volatility. So I know that sounds kind of stupid, but that's really, there's another saying in the market, when volatility is low, it's time to go. So let's go back to the S&P 500 real quick, and let's just look at what we have. We've got all-time highs at a point, an area of resistance. Okay, you got the market putting in dojis and all this. I mean, if you have a 401k and you're not on the sidelines yet, I'm just telling you, this is a great place to just say, yeah, I think I'll just sit on the sidelines, see what happens. Because we have very, very low volatility. We have prices at new highs. We're at resistance for this particular trend. We've got a potential ending diagonal forming. I mean, there's just a lot of good reasons not to be in the market. So, but it's your money. You get to decide what you do with your money. I'm just here to help you kind of maybe understand the market in general. Last week we talked about bonds. We talked about the 30-year bond, which, remember, those run inverse to the yields. And we had an ending diagonal basically in the 30-year treasury. We can look at the 30-year yield, see what it looks like. I mean, if you were to map all this out, it would be an ending diagonal. Bonds pulled up. Again, it's the same as the 10-year. This could be the first move. This could be the first pullback. We're either going to have a pullback to just below here, or we're going to have a new low below here. So we don't know which one it is yet. We'll just have to wait and see, but we should know within the next week or two, maybe 3, and then we'll know what to expect on yields at that point. German market still in a downtrend. You can, just barely. It looks like it wants to break out of this line, but it's right there. Japan, I mean, basically what you got in Japan is you got the central bank over there trying to create inflation. So Japan, the Japanese market, the Nikkei, it could take off from here and actually, start making higher highs and higher lows and actually be a place where equities are going to grow. The problem, though, is the people that live in Japan are just, it's harming them, right? It's making, I mean, their apples are already $4 each. They're gonna start paying $10 each for an apple. So it's just, the governments are really doing the wrong things. They're setting all of us up for really hard times, and I don't know. I don't know what any one of us is gonna do about it. Collectively, we can start calling for the end of central banking and stuff like that, and that'll help. We could get away from currency systems and go with, hard money systems that are either backed by gold or just gold, you just you just start paying for things in gold and silver. But these currency systems basically steal money from the population over time, and that's a problem. And it's getting to the point now where it's these other problems that have been created are going to be too difficult to deal with, and there's not going to be anything anybody can do about it except just start defaulting on things. So we'll see how it plays out. Nobody knows for sure exactly how it's going to play out. It's like I told my wife, it's like a chess match. The government does something, you do something. Government does something, you do something. So, and on that note, why don't we go look at the dollar? The U.S. dollar, we're expecting the U.S. dollar to accelerate up away from this little downtrend here. We had this large correction that ended with a low back on, what is this, May 2nd? And it's been climbing up ever since. Might have a little pullback here that could even take us back to 94 area. But it looks like the dollar, now that it's broken this trend line, it looks like it wants to go out. We've talked about, numbers up in this range around 104, 106, potentially even higher, especially if it gets here, makes a little bit of a sideways pause to down, and then starts taking off again. So now during this time, we should see, you should see things like gold pull back. So let's go ahead and take a look at gold. We've been talking about gold is ripe for a pullback. And certainly if the dollar breaks out, I think you'll see gold pull back. But here we are with gold right here. You can see we had an up week for gold, but not a great up week because we ran all the way up here and then pulled all the way back. So gold might pull back, another week down here, and then look for gold to maybe come up here and then pull back for real for a good long while. Either that or it's already in its pullback, and this is the first wave of the pullback, and here's the second, and we're going to see gold pull back. I talked about a pullback down into this area. It could be more shallow depending on what's going on in the economy and whatnot. So, play that by ear, but I think a good place to be looking to buy gold would be right around here in this 1180, 1185 area. Silver is kind of the same thing. Not sure why I can't zoom in here, but silver's the same thing. I think the difference though is I think for sure silver is going to experience one more new high, like up in this area, and then I would look for silver to pull back, all the way back into this this area here. So, like this, and then start rallying again. So, the euro has been just chopping around, very frustrating. It could be when we're in the last little blurp up and the euro's going to fall. I mean, I don't know. The euro, it never did come down very, all the way down here. So I'm not sure if that means it's still got to come down here first and come back up or what. But certainly the euro is not through making lows. It's just a question of, how exactly is that going to unfold, I think. Oil, oil had this huge run up here. We talked about these targets. And I think what you got this pretty significant move down in oil. I think what you got now is you got this relief rally going on. So, markets don't go straight down. They go down or up for a while, and then they correct. So you got some sort of little correction probably happening here. And then I would say oil probably resume its downtrend after this is done. So maybe look for, if you're looking for a place to short oil, maybe look around this 45 area for shorting. It's probably a good area to short oil. Again, that's up to you. It's your money. You get to decide. That is really, let me go back to make sure there's nothing I've left off. We're just in a, I don't know, again, the market's very frustrating. Here's the Wilshire. This is not real data. I don't know why I can't get good data on the Wilshire. It's very frustrating. We look at the global Dow. The global Dow, you know, I showed you last week all these global markets were down. And the global Dow, if you look at it carefully, looks very corrective given this move down. You can kind of see here, this kind of looks like, you know, an A, B, C, especially now that you're getting kind of a doji kind of price action here. I would look for the global Dow to start following pretty dramatically here. Let's just look, just for grins. Let's measure with Fibonacci from high down to low and see what kind of correction we've had. Yeah, so we've already had a 62% correction here. This is very common in the first pullback after a first decline, or a first pullback after a first rise. 62%, and actually we've gone a little bit further than that, and now we got this doji. I mean, what would really be bearish is if next week we had the market opened up down here somewhere, and left a gap right here, and then just left us with a candle that kind of looks like this. That's a dark cloud cover, or sometimes they're called an evening. I guess this isn't a dark cloud cover. It's probably called an evening star. It's a 3 candle pattern that when you get a break below here. So the way this pattern confirms is when you get a break below the low, or a close below the low, or below the low rather. So let's say you get a candle that looks like this. This would be an entry to the downside. So again, this is kind of an evening star pattern using this candle here, this candle here, and this candle here. If we get a gap down next week, then you wait for a close below this low, and generally speaking, that will continue. Okay, and if that does, then we'll definitely be getting our pullback in the S&P 500. So let's go back and look at the S&P 500 and just talk about briefly what I'm expecting here. And I've been talking about this for a couple of weeks. The problem is the market hasn't been cooperating, right? And that's what the market does sometimes. You know, because the market's difficult to predict. You know, you don't know that you're going to get, you know, 1, 2, 3, 4 weeks of just basically sideways action. So, you know, start looking for a pullback here because we got a little bit of a doji, and then you get this pullback, but then a rally back up to new highs. So that wipes out kind of what you could see on the chart right here. Now you got new information, but you're also, you know, notice nothing is breaking out of this trend line. This trend line is holding. And so that tells me that maybe it's not going to be this week. You know, maybe we'll get another doji this week, but it tells me that a pullback is imminent, and that we should look to at least pull back to this trend line. And if we pull back even lower, like down below here, then we've got some other potentials. Other potential things happening in the market, and like I said, we would be talking about that. So anyway, that's what I see as of right now. Things can change. You know, news changes things. Banking catastrophe obviously could change things. So just keep your eyes and ears open. Stay out of bonds. Don't put any new money in bond funds. If better yet, just take money out of bond funds. That you'll be better off if you do that. And excuse me, a little afternoon lull here for me. But and consider taking some money off the table if you're exposed to equities, like in mutual funds and things that follow the S&P 500. All right, everybody, that is it for the week. Really appreciate you tuning in and watching our videos. Certainly, you can forward a YouTube link to friends and family to get them to help them take better control over their money. The middle class investor is really just here to help people make good decisions about their money. If you turn on the TV, you're going to get bad advice. If you talk to your broker, you shouldn't get bad advice, but the truth is, you tend to get bad advice. They tell you to, all kinds of cliche things like, if you were out of the market last year, you would have missed the 6 best days in the market, and just stuff like this. Or you're young and you're in it for the long haul, and it's all cliche type stuff. So nobody cares about your money like you do, and the best way to make sure it grows and that you don't lose it is to take more action in your life with respect to your savings, your retirement, things like that. Okay? All right, everybody. Thanks a lot for coming in. We'll talk to you next week. Bye-bye.